Spotify, what's it worth, where's it headed from here. Today we're going to be looking at the stock. We're going to run over some of the fundamentals, and then we're going to go into a valuation to see whether it's going to be heading up, down, or flat in the future. So for Spotify technology, we have a price per share of $258. We see for the price to earnings, they operate at a loss, and their market cap is $51 billion, where their enterprise value is $47 billion. Looking at their cash to debt ratio, we do see that they have 2.49, which means that for every dollar of debt, they have $2.50 of cash on hand to pay down their debts. For their profitability, we do see their gross margins are 25.64 with a median of 60. They're well below the median. So the first thing that's jumping out at me is a lot of yellow and a lot of negatives here for their margins. Versus history, this is not the best they've done in a while, although for free cash flow, this is a good sign that they have 5.1 sitting just below their 10-year maximum of 6.48. So just below their maximum for free cash flow margin in the last 10 years. Other than two good signals in their free cash flow and their cash debt ratio, there's not too many highlights I do see here. We see that for operating and net margins, they're in the negative. And for ROE, ROA, ROIC, and ROC, my management indicators, we see that the management is also performing sort of mediocre in the industry, and versus their history, less than their median for most of these statistics here. The company has a forward price to earnings ratio of 85.97, and versus the industry, this is well above the median here. I don't put too much weight on the forward price to earnings, but this does tell me that there's a lot of growth priced into the business. We see they have $14 billion in trailing 12-month revenues versus that $50 billion market cap. So just about 3 times their trailing 12-month revenues. Although with the company trading at a loss, it's a little bit less relevant that their revenues are $14 billion. Looking at their financials on a trailing 12-month period, we see that they actually became positive in their net income here in 2022 and then fell back in the negative thereafter. Although their cash to debt is sort of interesting, their cash is outpacing their debt, and it looks like their debts are even mildly decreasing as their cash pile is increasing. Looking at the shares, we do see share sales here, so diluting shareholder value. When we look at their operating revenue by business segment, we see that ads make up 12.7% of their business, and the premium subscribers make up 87% of their business. It is fairly diversified. We see that the United States makes up 39% of their revenues, the UK makes up 9%, and other countries make up just about 50%. So fairly spread out across the world. And now it looks like it's just a matter of making the business a little bit more profitable or positive in the cash flows. But to see what's currently priced in and where it could be headed, let's run a DCF. So we see, first thing here in the DCF, no business predictability because it hasn't been around for all that long. So there's no earnings per share data for the 10 or 5-year average periods. And on a 3-year, it looks like their average is losing 10% a year in earnings per share. For free cash flow, similar story for the 10-year. For the 5-year, they are negative, and for the 3-year, they have grown on average at 47.6. So the free cash flow is not in a bad situation, although the earnings per share is sort of questionable. Let's just see what's currently priced in for free cash flow. So it looks like for free cash flow, there's between 30 and 31% growth priced in for the next 10 years to equal a fair value of roughly today's stock price. That's only for them to be worth what they are today. So if they wanted to be worth even more than they are today, at least for a fair value, they would need to earn over that 30 to 31% growth. And if they execute anything worse than that 30% growth for the next 10 years, then they should be worth less. But obviously stocks can trade for a premium, they can trade for a discount, and from time to time they will do that. So it looks to me like right now the company could be trading at a very high premium compared to what it realistically should earn or should be worth. Being unprofitable currently, it's just not one of those things that I want to jump out on a limb and bet that they're going to grow at 30% every year for 10 years and even do better than that to be worth more in the future. So to me, it's looking a little bit pessimistic for the stock. Again, the stock could double from here, it could triple, it could be cut in half tomorrow. And it's not like they have a monopoly either. Spotify, Apple's coming for them. Apple wants their position, it wants their customers. They're doing some good things, but realistically, I don't view Spotify as an essential business or a well-moted business. But it is interesting seeing how the stock has run up recently. If you have any opinions on this, if you think the stock's going down from here, up, let me know in the comments. Leave a like, subscribe, and I'll see you next time.